Hello everyone, welcome to our Egyptian Online Seminar group. First, copy my phones off. Then, if you have any questions, you can ask our speaker during his presentation or after his presentation. I have great pleasure of welcoming Professor Gregory Waymire. Gregory Waymire is one of the top accounting research leaders in the world. He is a professor of accounting at Emory University. He has served as president of the financial reporting section of the American Accounting Association, as well as vice president of research and president of the American Accounting Association. His research has been published in top-ranking journals accounting, such as the Accounting Review, Journal of Accounting Research, Journal of Accounting and Economics, Accounting Organization and Society, and Accounting Horizon. Now we will start our seminar with Professor Gregory Waymire.
Thanks for the introduction. I'm delighted to be with you here today, talking about a paper I've been working on for quite a while with Sudipta Basu. The paper deals with the issue of double entry bookkeeping. And when I think about my involvement in the project, it goes back many years to when I was an undergraduate. And in those days, like in the present, you would learn double entry bookkeeping right at the start of your accounting education. And the people who were prone to extend their education in accounting would be people who would typically become CPAs, and I was very much in that track. The question that we're exploring here, though, is even though you know accounting by double entry quite well, it's still a very difficult thing to wrap your hands around and try to understand why it's taken the form that it has. And this paper with Sudipta is an attempt to try to get a handle on that question. So what I'll talk about today are 5 things. I'll start out with a thought experiment to try to give some very intuitive understanding of what we're after here. Then I will talk about the evolution, providing an overview of that in terms of the story that we're telling. So essentially what we have here is a 3-step dance. There are 3 key parts to it. And it's intended to describe how transactions and accounting co-evolve with how the mind sees those transactions and the accounting. I'll then move into the meat of the paper, which is essentially transaction analysis and profit measurement in single entry versus double entry, because they are quite different. And they seem to be mainly mechanical, but the difference between them is substantive, and it runs deep, and it explains, in our opinion, the differences between them and the startling effects that they likely produce. And I'll talk about that further, going into entrepreneurs' decisions and wealth creation under both single entry and double entry. And then most importantly, I'll finish by talking about future empirical work, which is the ultimate motivation for doing a conceptual or theoretical exercise like the one I'm going to talk about today. So I'm going to start with the thought experiment. What would happen in a world where double entry bookkeeping had never been invented? Well, it would mean 2 things. The first of which was that single entry would be used everywhere to record transactions and prepare financial statements. Much the same way that double entry is used in a comprehensive way, but what would be getting done would be very different. And my sense is that the differences are that when we think about single entry, part of its application today, if people wanted to use it, is because it has been retrofitted over the centuries to do some of the same things that humans learned about accounting by using double entry, right? And so you can see, if you go back, the best example I've seen is one that goes back to the 19th century. It's a textbook on accounting by single entry, but it's written from the perspective of being adapted to needs that were identified by the use of double entry. So the thought experiment is, would our world be any different if double entry bookkeeping had never been invented? And number two makes that a very difficult question to answer. And intuitively, the reason is that if you're trained in accounting and it's stuck with you in your head, you see the world in very different terms than the rest of humanity sees it. And what that means is it takes hold in the very fiber of our minds and how we see the world and how we see economics and transactions and all of those good things. And so it's very difficult to actually do the thought experiment because it's hard to see a world in which double entry bookkeeping never came to exist. And that's the kind of exercise that we want to induce here. So the story we're telling involves a three-step dance. It's future oriented, double entry is, and that's kind of contrary to the way most people see it, at least the way that textbooks see it. But there actually is a future orientation to it, at least in relation to single entry, that has three consequences. The first is its function. What double entry did relative to single entry was to loosen the constraint of a sole focus on the present. So as I'll talk about in a minute, single entry essentially is focused on the here and now. But double entry breaks that link. And that's the key feature. What that allows people to do is to see the future differently, right? So the current period right now, in the way that we do accounting under double entry, is linked with what's going to happen in the future, and then also what's happened in the past. When we do journal entries, we think of them in part in terms of things that have happened before and things that are going to need to happen again in the future. And those might indicate additional journal entries that need to get made. So this future-oriented focus is focused mainly on profit. And that's Werner Sombart's contribution, that the function of accounting is driven towards measurement and identification of profit and its causes. The second is that the means through which double entry evolved over time is the debits and equals credits constraint that requires an accountant to basically balance all entries with the debits equal the credits. And that leads to asking very different kinds of questions that you do if you're applying single entry. And we'll talk about that in a second too. And then the final story is has to do with essentially the selection of accounting methods and selection by the environment of accounting methods. In other words, which firms were more likely to survive and which firms are likely to survive longer. And we're going to argue that double entry essentially promoted the survival of firms because of the improvement in profit measurement practices, and it's tied to the future and the ability to organize our thinking around the future much better than we would under single entry. So it's a co-evolutionary story where accounting is adapting in line with changes in transactions as well as the mental analysis of those transactions. So you have a link between the nature of economic exchange, how extensive is it, how broad is it, how many periods, things like that. Then you have accounting measures, and we're focused on the double entry system and how that affects accounting measurement. But the other thing that's going on in the background is a critical feature of it, and that's the mental evaluation of transactions that takes place both when accountants do transaction analysis and also when executives make decisions about the firm's scale and scope. So there's three key features to this story. There's bidirectional endogenous links between all three of these factors. It makes no sense to think about accounting as being something that's influenced independently of the nature of transactions that has to be accounted for. and how we see them mentally. So what that means is that accounting measurement affects exchange directly and both indirectly in terms of how we see those transactions we're trying to consummate. And then third, that the measurement system quality is not something that's narrowly and focused on, say, single kinds of things like accruals quality measures. It's reflected in the strength of the associations that are built up in practices, as well as mental evaluation of those practices in sort of executing the accounting. Okay, let me move into transaction analysis and profit measurement with single entry. And this is a key part of the paper, because you have to be able to get your head around how it is that the accounting will work differently under a single entry system versus a double entry system. Because if you don't have that, you can't really think about asking the question of how double entry really changes anything. So a single entry system, if you think about a merchant in the 19th century who's tracking inventory in his or her store, basically what they're going to be doing is tracking physical quantities and flows of inventory items. And units of currency will not be in a single cash account. They'll be tracked separately. So you might count the number of pennies, the number of dollars, the number of quarters, and things like that. And it's important to keep in mind that the system is focused primarily on the reduction of theft. So you want to know how much stuff you have and how it changes over time with each transaction. And that leads to a different kind of transaction analysis than we do in double entry. Transaction analysis under single entry focuses entirely on immediately observable resource changes for a given transaction. It almost always is not the case that profit recognition ever occurs in a journal entry during the period that you're doing the accounting. It's when you do the books at year ends, because you've got inventories, for instance, in physical quantities, not in dollar values, that at the end of the period, you would sort of do an inventory of the whole business and then apply valuations to that. And the profit calculation you do would be for the period in comparing your ending net asset value with what it was, say, a year before that. So our claim is that single entry does not require thinking beyond the immediate here and now, right? So we're focused on identifying what we own and how that changes with transactions. We're not focused predominantly on profit. We're focused on keeping people from stealing our stuff. So I'll give you an unrealistic example of single entry. You have a candy store that buys a pack of chewing gum to hold in inventory. They pay 37 cents for it. And that involves paying 1 quarter, 1 dime, and 2 pennies. But you can think about it in terms of actual coins. And again, this is unrealistic because a candy store owner doesn't buy a single pack of chewing gum. So the way that would be recorded is that the candy store owner would add 1 pack of gum, 1 unit of gum to the inventory of product, and there would be a reduction in quarters held, dimes held, and pennies held. Then if a customer comes in and buys a pack of gum from the store, paying 49 cents in the form of 1 quarter, 2 dimes, and 4 pennies, what that means is that you've got a transaction where we think of it as a 12-cent profit on the transaction. But in a single entry system, you're basically tracking the physical flows of things that you can keep track of, like the inventory and the coins. And so that's what's happening. There's no reckoning of profit immediately at the point of transaction. What they do instead is at the end of the year, they calculate profit over all transactions using end of year fair values. And so in that sense, most of the standards we see by boards like FASB could be applied using single entry bookkeeping. A fair value standard for certain kinds of assets, for instance, would fall into a single entry bookkeeping system. Now, the work involved in getting those values may be very complex and difficult, but conceptually, that's an estimation problem. The accounting per se is pretty straightforward under a single entry system. So the mental evaluation of an exchange transaction with single entry is going to be pretty straightforward. You have a consumer and a producer. They have a transaction that's proposed and then executed. And the consumer is going to be consuming the product and discovering the utility that comes from consumption. The producer is going to, at some point in time, try to discover the profit that is generated on the transaction or transactions in total. The post-exchange obligations may be a follow-up like a warranty that an automobile manufacturer has to do. Then the actual consumption will occur. And is it worth what I paid for it as a consumer? On the producer side, there's a transaction analysis and recording. And if it's under a single entry system, the question that's predominant is going to be which resources have changed and by what amount. On the demand side, on the buyer side, you have some post-exchange evaluation that's taking place. And then you have a feedback loop that comes after that evaluation, and you have that effect there. You know, it comes back and it feeds back to the consumer, and they're asking questions like, would I buy this product again? On the production side, you have the seller asking, have my interests been protected? Right? Did I gather assets in this transaction that keep me whole in relation to my net worth? And then there's a supply side feedback loop as well. And what we're going to argue is that this feedback loop is stronger under double entry than it is under single entry. And I'll talk about that right now. So the transaction analysis and profit measurement with double entry is that debits equals credits imposes a constraint on all transaction entries that encourage the use of wealth accounts to balance journal entries for profit-seeking transactions. So updating the wealth account, retained earnings, if you will, focuses attention on changes in wealth and how wealth is affected by different kinds of transactions. Thus, the changes in transaction analysis are constrained heavily by debits equals credits. Whereas if you think back to what we were talking about with single entry, that no such thing happens, right? We recorded the acquisition and sale of the chewing gum and the movements of cash, but there was no reckoning of profits in those transactions. Measuring income under a double entry system leads to a focus on future contingencies, right? So you're focused on what's going to happen in the future. Indeed, you can't recognize revenue on a transaction where there's high uncertainty about whether you will actually collect cash at some point in time in the future. The questions that get posed under a double entry system reveals a latent demand for accounting knowledge to do things like defining revenue and expenses. So the process of transaction analysis is raising questions in a very basic way that are different than you would be raising under a single entry system. So modern accounting principles have descended in evolutionary terms from norms that emerged from answers to questions raised in double entry bookkeeping's based transaction analysis. And you can think about these answers as constituting a common law of accounting evolved over multiple centuries, dating back at least to the 1300s. So within the context of the simplistic example before, instead of what you have here, you have T accounts that keep track of the inventory. And you only need one account for cash, and it's denominated in dollar values, not physical quantities. So when they buy the gum for 37 cents, they add that to the gum inventory via a debit, and they reduce cash by a credit to the account to the same amount. When the sale is made, the gum inventory declines by 37. Cash comes in at 49. Now, if this were a single entry system, you would just declare victory and head home. There would be nothing else you have to do. But under a double entry system, you have to balance the journal entry. And that's done through a credit, if you will, to cumulative wealth or retained earnings. So the mental evaluation of an exchange transaction with double entry is fundamentally different than it is with single entry. You have the same consumer and producer proposing and consummating transactions. Utility and profit are to be discovered at some point in time in the future. You have exchange obligations performed, so there's nothing here that's any different under a single entry versus a double entry system. The same thing still exists on the demand side. There's a feedback loop, and that's how a consumer does that is independent of the double entry system as it's used at least by the producer. So the producer is going to ask in transaction analysis and recording the transaction, did I earn more than it cost me to produce this thing? And then more importantly, should I change what I offer to consumers in the future? And that feeds back to the consumer at some point in time in the future. And we're depicting this feedback loop as being much stronger because we think that this is one of the key differences between double entry and single entry because of the nature of the questions that get asked in transaction analysis. And so essentially what we're saying is that the supply side, the feedback loop on the supply side of the market, when you're using a double entry system is stronger than it is if you're using a single entry system because you ask different questions. What are the effects of those feedback loops? One is that double entry bookkeeping works like eyeglasses to improve vision of what has happened in the past and more importantly, what's likely to happen in the future. And as a consequence, double entry fosters more rapid adaptation to change opportunities than single entry, essentially because the system is picking up new transactions and they're feeding them back potentially into profit calculations to the extent that the system has adapted to a higher level of complexity. You're going to be able to adapt the firm to things that are happening in markets than would be the case with a single entry system. So a slower adaptation with single entry can be depicted as follows: that when we did the entry for it, if we sell a unit that cost us $40 and we sold it for 50, the cash will go up by 50, but inventory will go down by 1 unit. The result is that the entrepreneur may know that profit is greater than 0, but he may not know very well how much. And as the number of transactions increases, the identification of profits by transaction types will be noisier, all else equal. So we depict these little bubbles off to the left, which are transactions that are already occurred. We know that there's some that are profitable, some that took place at a loss, but we may not know how different those are and how numerous they are. We'll know the total profit at the end of the period, but as we engage in more transactions during the year, things are going to get fuzzier under a single entry system. Result is that you do the book closing at the end of the period with evaluation of assets and debts. Single entry provides a blurry vision of profits for individual past transactions, as well as by category type for those transactions. And on the other side of it, we're telling a story that double entry is going to induce more rapid adaptation in the product market. This is the entry that essentially gets made for the same transaction I just talked about. So what happens is that double entry imposes the debits equals to credit constraint, and that implies we're going to have to consider valuations and why they vary from one another. The consequence is that the entrepreneur can more easily measure the profit for individual sales, and more importantly, retain it in effective working memory. And so if you look at this picture now, the total profit at the end of the period can be broken out by product type. And you can identify under a double entry system the profit associated with individual transactions. And the consequence is that you're going to have a much clearer picture of what has happened. And the result is that you've got better profits measures. And the key thing is that you can forecast the future more clearly and adapt your business decisions appropriately. Okay, the downstream effects of the feedback loops. Better understanding of what has already occurred leads to better prediction of what's likely to happen in the future. So in other words, you can think about past transactions being associated with current transactions, which in turn are associated with transactions in the future. But it's not all in one direction. Future transactions influence what we do today differently than would be the case in the past. And in turn, current transactions have resulted from stronger links to the past because those relationships can be identified. So what we're saying is that double entry bookkeeping relies on mental time travel, where the present is more strongly linked to the past, and it both is influenced by and influences the future to a greater degree than it would under a single entry bookkeeping system, right? And we know this is true when we teach accounting and we think about a transaction and we write the journal entries up on the board. It's easy to go into, okay, what happens after this? We make a credit sale where we receive an interest-bearing receivable and we give up an asset that it costs less than the present value of the future payments. And so we know how to make the journal entry right now. And presumably we thought about that at the point in time that we designed the credit policy. But in the future, when payments are made by the buyer, we have to recognize a chunk of interest expense, interest revenue rather, as well as having that differentiated from the regular sales level on the transaction. So what we're saying here is essentially that there are links that get built up between the present and the future and the past. And those links are stronger under a double entry system because the double entry system encodes information more rapidly on transactions that are taking place in product and factor markets, if you will. So that's a lot to process. Before I move on, I think I'll ask if there are any questions that anyone has, and I'm happy to sort of stop and respond to clarifying questions if anybody needs anything on that dimension.
Hey, Greg, this is very interesting, but it reminds me of the 1980s when even accounting textbooks tried to take out debits and credits.
Yes.
You remember
that? All too well, Doug. It was emblazoned in the front of my mind.
So we went through a period of about, I don't know, 5 to 10 years where we basically handicapped all of our accounting, MBA, all students with this idea that you didn't need to know debits and credits. And
Yeah.
it didn't go too well. We're back. We're back to debits and credits. Thank goodness.
Well, I think that the reason for that is that it's not the debits and credits per se, it's the analysis of transactions that you have to go through to be able to identify what the debits and credits are.
Yeah, you
And
can't even figure gain and losses, revenue and expense without understanding something about debits and credits or left and right. So yeah, it's very, very interesting.
Yeah. Any other clarifying questions?
Question from Professor Anoop.
Oh, hi, Greg. Your example is highly related to companies that sell products where costs can be linked to revenue.
Right.
As we move towards economy, which is more and more fixed cost economy, does the relevance decline? Given your example, does the relevance of double entry decline?
No, I think it's still there. I mean, you want to be able to identify transactions that have occurred in the past. And so product cost may have a large fixed component, but there's always a variable component that you want to track how that varies across those products. And so in that sense, it may be lessened, but the system is still going to pick up better information than you would be getting under a single entry system, right? So, the way that I think about it nowadays, much of what the FASB has argued with fair value accounting could be implemented in a single entry system, right? And for a company that is one of the type that you talked about, that system presumably will work better in those circumstances than others. But it won't necessarily have up-to-date information embedded in it. Anything else before I go on?
Claudia?
One quick question. Thank you, Professor Waymire. Very, very interesting. I'm interested in the feedback loops.
Okay.
In particular, as you pointed out, the supply chain feedback, as we think about additional definitions of wealth creation. I don't know if in the remainder of your paper, we will be talking about how to begin measuring things related to non-monetary value related to environmental impact, for example, or social value. I'm very interested in your comments on that type of feedback loop in the double entry accounting. So I'll leave that out. It's not a question, just interested in your thoughts if you address them later. Thank you.
Okay, I don't actually address it because it's not easy to address. There's no transaction that occurs, right? In a case where you have, say, an externality, you have an externality because you don't have a market transaction that needs to be dealt with. I dump pollution into the stream next to my factory. I mean, to the extent that there are laws that are going to penalize you for such behavior, then the system might be called upon to record a liability associated with that and an expense that comes with that as well. But I really won't be talking about that directly in this presentation.
Thank you.
A question from Professor Steven Soltero.
Okay.
Dear Professor Steven, you can open your mic and ask your question.
Greg, the question I have, though, is if this is an evolutionary argument, how can you explain the fact that the actual transactions recorded under double entry accounting obscures the link that you're making rather than actually highlights the link? Because we do debit the cost of goods sold, credit the inventories, and then separate journal entries to record the sales. So how can this be given as an evolutionary argument where we're actually leading up to the point where we're obscuring what the nature of what you're proposing?
We're not necessarily obscuring it. It's just that the cost of identifying it is sufficiently high that it doesn't pay necessarily to create separate accounts where you can classify things in a meaningful enough way to do the measurement. So when you think about it, the argument that we're telling is that at any given point in time, based upon what people know then, they try to define a system that captures transactional data subject to the costs of doing that. And they learn things through time that allow them to do that better, or there may be exogenous events occur that make it harder for them to do it. But that's essentially what's going on. We're not making any statements about living in the best of all possible worlds. People are doing the best that they can, which is not necessarily supremely optimal. That's why some firms fail. And I'm not saying they fail because they don't effectively apply accounting. They'd fail for lots of reasons. But firm failures presumably are affected by the quality of information that a system pulls in. And the system that's getting the data is going to be conditioned upon what humans know at that particular point in time. Does that answer your question, Steve?
It's about as good as I think you're going to get. I'm looking forward to the rest.
Okay, thank you.
A question from
At this, I'll move on then if I can.
question from Jan Bone.
I'll let you go. I will cover my question later, I guess. Thank you. Thank you, Mo.
Okay. Hi, Jan. It's good to see you.
Good to see you too. Thank you very much, Greg.
Okay, let me move on, and then as additional questions arise, I'll deal with them at that point in time. So what I want to do is to move into some examples here. Where the first one is going to be where a builder contracts to build a bridge across a large river, the Ohio River in this case. For those of you who are not US aware, the Ohio River is a large river that cuts through the middle of the United States on the southern edge of the state of Ohio, north of Kentucky and West Virginia. So here we have a bridge that hypothetically there's going to be a price paid by the buyer of $60 million. It's going to take 3 years to finish it, and it's going to get paid for in equal installments over a 3-year period. Right? And there's an anticipated cost to complete the bridge of, say, $40 million, something like that. So there's a profit expected of 10 million. The initial entry under single entry bookkeeping is you record the cash inflow of 6 million and there's nothing else. You can declare victory and head home for dinner. Under double entry, you record the cash increase as a debit of 6 million, but you got to have an account that gets the credit. And is it a revenue? Is it a liability? And the way we account for it nowadays is using something like a percentage of completion method. We'll establish a liability that stays there until the contract is performed and the bridge is built in increments with estimation going on for revenues and expenses through time. The big question, though, is how can profit data from this and similar transactions be used by the bridge builder in figuring out what they want to do in the future? And the quintessential example is Andrew Carnegie, who used double entry based cost accounts to run his business, Carnegie Steel, which was bought out by US Steel in the year 1900. So this bridge that I'm talking about was built shortly after the Civil War in the US in the 1860s. And what we're looking at in the picture is a successor bridge to that. And he built it for one of the largest railroads in the United States at the time that wanted to be able to put a bridge there and be able to get their locomotives and rolling stock across the river from, say, the state of Pennsylvania to the Midwest. So when Carnegie started in business around probably 1850, he was in those days, they didn't necessarily go to college, but he was surprised that companies would use something like a single entry system where they computed profit numbers annually, and they took on large projects like this without a really clear understanding of whether that project would be profitable. Carnegie learned double entry bookkeeping in a night course that he took as a teenager, and he talked about it in his autobiography. And there's a corporate charter, covenant, the corporate charter for Carnegie Steel, where they were required to use double entry in terms of keeping accounts. So one of Carnegie Steel's big innovations was to develop a double entry based system that allowed the firm to estimate ex ante what they expected to earn on a specific project, right? Which could confer a competitive advantage relative to other companies that weren't doing that. And that advantage would allow him to basically underbid confidently what his competitors were proposing. Or if they undercut him, he knew that they would be facing problems at some point in time in the future. So the question that we would ask under our view of the world, would Carnegie Hall in New York City, which is one of the great classical music venues in the entire world, would that even exist if Andrew Carnegie hadn't generated the wealth that he generated using double entry? If you read Pacioli's Summa Mathematica in chapter 20, and the chapters are very short, I recommend that you get a PDF copy of it. He talks about the need to enter the value of things and to enter that stuff into the accounts because it allows you to get a much better sense of whether you're making profit on specific products, and then whether you want to change out what it is that you're trading in. And so this is something that was known early on. And Pacioli's book is not something where he wrote it down as sort of an act of inspiration. He wrote it down because he was describing practices as they existed at the time in 1494. The method first surfaced in very rudimentary, simple form, I think in the year 1311, which is the earliest that it's been traced. So people over the course of the next 200 years, not very rapidly, but they figured out how to use this method to identify profits and what was causing them to a much greater degree. The other example that we cite is 19th century meat producers in the United States. And so if you look at some writings by this guy, James Bliss, but it's also discussed by Alfred Chandler in his book, The Visible Hand. And Chandler's point is that the accounting goes hand in hand with the nature of the transactions that are taking place. For livestock buyers and ones who are going to prepare meat, that was enabled by the development of the railroads in the US, which allowed for the, if you will, the creation of meat, say in a place like Chicago, that then could be shipped by a refrigerated boxcar to New York in a relatively cost-effective manner. So it meant that you didn't have to ship the whole cow. You could process it in Chicago and they could have it in New York the next morning. But doing the kinds of activities that these firms did would have been exceptionally difficult under a single entry system, because what you really want to do is to identify the costs of the whole set of complex operations of deconstructing a piece of cattle into various meat products that people are going to want to eat down the road. And they figured out how to do this. And the people that were involved in that are people, names that are familiar, at least to Americans: Oscar Mayer, Gustavus Swift, and Peter Eckridge. They all started out as corner butchers, but they developed large-scale businesses. that were vertically integrated into buying livestock and then producing meat and then distributing it all across the country. Huh? So if we look at journal entries, they had raw materials and work in process and stuff like that. It's just that not like a steel producer, they would essentially deconstruct the raw materials into various products. So you would buy cattle and then purchase it at cost, and the credit would go through to either a cash or a payable. That there would be a transfer that resulted from a decision to put a cow essentially into production, which meant that you had to sort of slaughter the cow and then dissect it into parts and things like that. So you could think about that as a raw material, cattle on the hoof, being transferred into in-process meat, work in process. That would be combined with other costs, where you would have debits to the work in process inventories, and then credits to cash and payables. And then when the processing was complete, you would have dressed meat, which is essentially the things that people bought, as well as byproducts like lard and oil and stuff like that that would be used for other purposes and not necessarily food consumption. So ask a similar question about this process as we did with Carnegie. Would Oscar Mayer's Wienermobile have ever graced the streets of the United States of America if double entry bookkeeping had not existed? And this is kind of a tongue-in-cheek, funny kind of thing, but it illustrates the fundamental point that double entry has allowed a lot of people to do a lot of things better, probably in very small amounts than they would have otherwise. But those small amounts aggregated over millions and millions of transactions are actually quite large. So the thing is, what do we do with this? How does double entry bookkeeping improve profit discovery? And that's the big issue that we're going to be after with empirical work. And so what we're talking about here is that double entry bookkeeping is like a multiplier effect. It magnifies the gains from division of labor and exchange beyond what you could do with under a single entry system. We're not saying that you couldn't do some of those things with single entry. We're simply saying that you could probably do them better with double entry. And we give several examples in the paper of that, including Carnegie, Rockefeller, the Volckers in Germany, in, I think the 14 or 1300s. So essentially what we're saying is that if you think about a regression setup, you have some performance measure on the left-hand side and measures of assets on the right-hand side. It's not, double entry doesn't enter as a 0-1 variable that shows up as an independent effect on profit or performance. What we're saying is it affects the mapping from assets into profits. And so it's different that way. It's not something where you can twist a dial and it shows up as an independent effect. It has system-wide effects that affect essentially the coefficients mapping assets into performance within that setup. So what are we going to look for? The what, how, and why questions really ought to be driving that. Some of them will be survey-based that look at why it is that firms adopt double entry. You know, at some point in time, you start a business, and it starts out as a small organization, and you're probably keeping receipts in drawers, and you might sort of keep logs of material purchases and stuff like that, or cash bookkeeping and stuff like that. It would be useful to know something about that. Most of us who teach accounting have no idea how that works. But somebody does. And it would be a good idea to survey them and find out things like, okay, when do they make that decision? How do they handle bookkeeping? Is it outsourced? When do they hire CPAs? And then a more interesting thing is something like, how does the chart of accounts change in a company as it scales in size, right? So you can imagine one of the examples that Judith and I encountered years ago, we were talking to somebody in the People's Republic of China, right, where they were trying to think about developing businesses from the ground up. And it would be interesting to do field research in those settings to sort of see what it is that goes on. What kind of issues do they grapple with, and how do they define charts of accounts that pick up different components of their operating activities? The how question, as you learn double entry bookkeeping, how does it affect how you analyze a business transaction? So if you think about a 19-year-old kid who shows up and takes double entry, right? And you ask them to analyze a transaction and what something means, they're going to give you a very different answer at the start of that course than they will at the end of the course, right? And so you could imagine process tracing kinds of experiments where you're trying to get a handle on what's happening as people are grappling with transactions that become increasingly complex. How does use of double entry bookkeeping affect a decision maker's ability to forecast future sales and earnings, right? So that's a key element of the story, that you pick up information that's more timely, that allows you to actually generate forecasts of the future better than you would otherwise. And then the big question really is, how do accounting brains develop when people learn double entry bookkeeping? What kinds of relationships, if you will, or connections between neurons are built in human accountants' brains versus, let's say, normal people, right? And we know if somebody asks us, "Oh, you're an accountant," you know, let's say you're different, and they will, you know that you are, but it would be interesting to know if there's any physiological basis to that.
Bro, a question from Professor Shyam San.
Hi, Sean.
While you finish, I'll just ask, well, maybe I can ask right now. You know, this is wonderful. Thank you for a great talk. In the second column under how, number 5, how does the experience of double entry affect decision makers' ability to forecast?
Yeah.
I wonder if you might be willing to change that a little bit, slightly, because what I'm thinking of is that Carnegie and other businessmen going back hundreds of years benefited from it because the fact that they or their accountant was going to record this as a double entry, the consequences for their equity, their profit, and their wealth entered into the decision about the transaction itself. That's what you're trying to say in 5.
Yep.
And so the decision making included that anticipation of how it's going to be accounted for, and therefore change the decisions themselves.
Yeah.
I think you said it, but maybe slightly different words. You know, that's.
No, I think that's absolutely true. You know, there was an interesting neuroscience study done probably about 15 years ago now, where two people were playing a trust game, and they were hooked up to fMRI machines while they were playing it. And what the researchers were able to do is to measure neuron activity in the brains of say a sender and a receiver in a trust game, right? And as they developed experience in playing the game, it came to be that parties would start anticipating the behavior of the counterparty, and it would show up as earlier firing in the neurons than would have been the case otherwise. And so that's essentially what I have in mind. And if you go back to one of the early slides where we depicted these bidirectional endogenous links between transaction, mental analysis of transactions, and the accounting for transactions, what you're saying falls into that very nicely. So in other words, it's not just the forecasting ability, it's that the forecasting ability influences the behavior, which then feeds back and affects how you account for it again in some sort of evolutionary stream of things, right? And so the depiction here is, I agree with you, it's a little bit simplistic, because what we're trying to do is to cut it apart here. And in some regards, there are things that are very difficult to cut apart, but you could get at them with certain types of experiments, depending upon how you sequence activity within the experiment.
Thanks.
Yeah. Okay, the last part of this is the why. It would be interesting to try to figure out what happened with the spread of double entry over history. When did it find its way into different kinds of economies? What can you get measures of its use within those economies, perhaps by looking at textbooks that were available and the sales of those textbooks, coursework within the country. Those things have been done for the United States, and I sense for some other countries as well. But it would be interesting to track, to the extent that you can get macroeconomic data on it, the spread of double entry to different parts of the world and how it affected or was correlated with changes in things like GDP growth rates, stuff like that. If you can figure out ways to get microfinance data on small businesses that are starting up, you might be able to address that as well there. Thought about simulations and experiments where some firms had, and we've taken preliminary steps on the experiments. Some firms having access to double entry and others not. They have to do it in single entry. That has turned out to be a more difficult nut to crack in the lab than we anticipated it would be. And so we've gotten a lot of data, but it's not been very good. So, you know, the idea of doing a world where there's no double entry bookkeeping means that you literally do have to provide transaction data and asset changes, but not provide things like sales revenue and cost of goods sold and stuff like that. And actually pulling that off in the laboratory has proven very difficult for us. But we'll get there. So essentially what we're talking about is a combination of case study experiments and archival research using correlational data at the macro level. This is my last slide, so I'm happy to take any questions from anybody that you have, and or we can talk about anything you want.
Thank you very much, Professor Gregory, for this excellent presentation, and thank you very much for your contribution and your effort. Now, if anyone have any questions, you can open your mic and ask your question.
Can I ask a question, Greg? This is Jan Bouwens. Yeah. So my question is, so it seems to be the case that in the observation of society that we, in the financial measurements, are missing out on a very important part. And that important part is what we now call ESG measures. And so
Say that again. Yeah,
ESG, sorry, we are now going into a world where ESG measures become, very important next to, all of our financial measures. And one of the issues that I was thinking of when I was reading your paper was that, when we look at ESG reporting, we actually totally miss out on this whole concept that you were referring to with double entry bookkeeping, which helps us to actually attribute how we should look at events, how these events are related to current profit, but also how they can relate to our future.
Mm-hmm.
These non-financials, mostly non-financial measures of ESG measures, are totally disconnected from this whole idea as to how they really can affect our future, right? We just have to make some estimate as to, okay, so here we see a number of a firm that is doing worse than other firms in terms of their in terms of their emission. So then I have to just make an assessment as to how that is going to affect future profit or future value. While if we are in the transaction system that you have described, right, we get a far better idea as to how even a current transaction is related to potential future transactions.
Yes.
So should we not go into an endeavor, and we had some discussion also in the chat on that, I guess, should we not go into an endeavor where we also try to do a better job in understanding these measures like ESG measures, and also put them in transaction type of world as we have been doing with double entry bookkeeping, because that is really helpful and has been very helpful as you described.
Well, if you think about it, it's not a great leap of faith to think about the data that are collected within a double entry system, raising questions that would lead to the production of non-financial measures that would address these kinds of things, at least in part, right? So, non-financial measures that are looking at environmental impact that don't link up necessarily really well with the double entry system, at least in a direct sense.
Right.
My sense is that businesses are starting to do a whole lot more of that, and whether that will be successful and useful, I have no idea.
Yeah.
But it's in some sense the same kind of thing that happens in other measures that aren't focused on externalities, right? So if you read, again, Chandler's work, I think Johnson and Kaplan, in their survey of 19th century practices, deal with some of those kinds of things. So there are measures of say, operating efficiency that are denominated in terms that are only partly financial, but they're linked up in terms of how you analyze a business,
Right.
and they're not independent.
They're not. No. Thanks.
Thank you.
Yeah,
Hey, Tom, how you doing? Tom Stober. Good. An old friend of mine.
Are there another question? If anyone have any questions, you can open your mic and ask your question. Dr. Thomas, have any question?
Hi, Shudipta.
If anyone have any questions, you can open your mic.
Yeah.
And, yeah. If anyone have any questions, you can open your mic and ask your question.
I guess one more question related to Jan. In the chat box, I referenced Jacob Saul's book, The Reckoning, Financial Accountability and the Rise and Fall of Nations. And what he did is he attributed the whole rise of capitalism to double entry accounting. And his argument was, with double entry accounting, you could hold people accountable for their actions, whether they sailed across the ocean and came back and were delivering products and goods, or within the community. And so I think some of our attempt to hold people accountable for ESG measures and so on is also consistent with double entry accounting. If SALT is correct, and double entry accounting really allowed us to track assets, liabilities, and shareholders' equity over time and hold people accountable, and gave us the opportunity to be transparent, I think it works well with externalities that we also want to hold people accountable for.
Well, it's interesting. When I think about the accountability question, the person who wrote most intelligently on that was actually Yuji Ijiri. And unfortunately, his work, which is masterful, is not taught in many doctoral programs anymore, although you may find a smattering of it here and there. But Ijiri's work was focused on accountability systems, right? And the use of double entry to hold people accountable. And he contrasted that with the sort of conceptual focus of the FASB, which sort of threw accountability out of the window, or didn't ascribe major importance to it in the same way that Ijiri did. I would like to see that work find its way back into doctoral seminars, because I think it would be useful for these kinds of questions exactly.
Professor Waymire, I have a question as far as I will stay on the ESG sort of journey. What are your thoughts about, I'm sure within your students and your academic work, regarding new practices in the economy related to circular economy? Well, how are you handling inquiries about that?
What do you mean circular economy?
The work that has been done by Ellen MacArthur, the concept of beginning to think about regenerative economic cycles, materials that become waste, and then that material becomes raw materials for a new product. So just really thinking about the circularity of processes rather than beginning to think of materials that we make, we use, and we throw away. So this is on the sustainability side of things.
So basically what you're talking about are economies that evolve, where the future actions are conditioned upon the past actions. It's always been that way. It's just that our understanding of it is not very good. Mm-hmm. We tend to see the world in terms of comparative statics of constrained optimization and neoclassical economics, which is not it's not dynamic. It's basically static. And when we're in that world, which we can get a handle on, mm-hmm. It is comforting to us to know that we can derive equilibrium and figure out how X affects Y and things like that. Mm-hmm. But it doesn't really capture those kinds of dynamic effects terribly well. So I think that some chunk of it is having a sense that we don't really understand those things very well, right? And the first step is to recognize that. Now, beyond that, you know, it's hard to sort of put substance or meat on the bones of that, because, you know, we don't really understand those things as well as we might. I'm sure that there are areas of academic work where things like feedback loops and dynamic behavior is the central part of it, but it doesn't really seem to go into how we think about stuff that's fairly simple like accounting. But it's there, you know, so, but it's hard to identify because it's getting produced from the ground up. And if you look at the history of it, you know, so there's this wonderful old text by Paul Garner that looked at cost accounting and how that emerged, at least within the United States. And that was basically a bottom-up process where firms figured out how to do it on their own. And it was difficult to do, right? You know, so the idea that you had a production process that, you know, mass production in factories really is less than 200 years, well, certainly less than 300 years old. Babbage, I guess, was writing about it in the early 19th century. Yeah, I'm babbling.
Very interesting. Thank you for your time.
You're welcome.
Professor Robert Kaplan from Harvard Business School.
Hey, Bob.
No, I just chatted something in relating to the discussion on ESG and circular economy, that financial metrics are important, but other metrics are also important. Financials are not capturing all the consequences from company decisions. So that's kind of the short answer. And
thank you. Hope
maybe
you were
in
well.
some future seminar, we can get into the other types of metrics that can be usefully deployed to deal with those issues.
Yes.
Thank you. There is another question. If anyone have any questions, you can open your mic and ask your question. Professor Basu, if you comment, or
he's a co-conspirator.
yeah. Yeah. I think that you have done very well with answering a lot of questions there, dear Professor Gregory. So thank you very much. And it's all that remains for me to say is thank you everyone that joined us, and I thank you very much for taking the time out to present to us today, dear Professor Gregory. It's been really appreciated. Thank you very much.
Thank you. I appreciate it. Bye-bye.
Thank you, Gregory.
Bye.
Nice weekend.
You too.